In the previous video, we learned that transfer pricing is commonly used by multinational companies to facilitate the remittance of funds from subsidiaries to the parent company within an international capital group. In this video, we will deal with the topic of transfer pricing in more detail. First, we will explain the basics of transfer pricing and discuss its objectives from the perspective of a multinational company. Then we will explain the transfer pricing systems and mechanisms which are typically applied by organizations. We will also explain the application of transfer pricing in the context of specific tax regimes and discuss why companies locate their businesses in so-called tax havens. Finally, we will provide examples of the application of transfer pricing to eliminate the consequences of restrictions such as tariffs and exchange controls. In the final part of the video, we will discuss ethical issues associated with the use of transfer pricing. As you know from the previous video, transfer pricing is an approach used by companies to circumvent restrictions related to the repatriation of profits from foreign subsidiaries to the parent company. In fact, transfer pricing may serve more purposes. Among the most often quoted is the avoidance of excessive charges such as taxes, duties and tariffs. By transferring profits to countries with more favorable fiscal regimes, transfer pricing also enables companies to manage the final consumer price of their goods in foreign markets, thus increasing their level of competitiveness. Last but not least, transfer pricing may be used as a tool in managing foreign exchange exposures resulting from operations located in different countries. You should be aware that transfer pricing is not limited solely to the purchasing and selling of goods between the parent company and its foreign subsidiaries at predetermined prices. The term transfer pricing is typically also used to describe such practices as charging subsidiaries with royalties, overheads and other expenses, invoicing subsidiaries for services rendered to them by the head office, such as human resources management or IT services, as well as using intercompany loans to take a look at the general rules governing the practice of transfer pricing. The most important component of a transfer pricing system is setting up the levels of prices which will be used to settle intra-group transactions. The unit transfer price is typically equal to the variable cost incurred by the entity supplying a given good or service, plus the opportunity cost incurred in association with selling that good or service internally. So the opportunity cost is the contribution that the company lost by not selling the product externally, or the opportunity cost of using the company's production capacity to produce goods for internal transactions instead of using it for commercial purposes. In light of the above observations, the transfer price will range from an amount equal to the standard variable cost of the production entity when there is no external market for the goods and no alternative and more profitable use for its production facilities, to the market price when the goods or services subject to intra-group transactions are marketable. In order to function properly, the transfer pricing system of a multinational company should be understood by the management of all participating entities and should be relatively easy to operate. For companies facing frequent organizational changes, it is also vital that the transfer pricing system is flexible. In any case, it must be properly aligned with the overall business strategy and methods of performance assessment of the entities participating in the system. Otherwise, application of transfer pricing could have an adverse effect on the productivity and motivation of management at the subsidiaries. There are three most commonly applied transfer pricing systems depending on the transfer prices. The first of these is the market-based system, in which prices used for intra-group settlements simply reflect market prices. It is important to note that market-based transfer pricing is generally approved by tax and customs authorities in jurisdictions worldwide, as it facilitates the fair sharing of profits between entities in a capital group. Under a market-based system, income taxes and other burdens are also split within the group, The main difficulty associated with application of the market-based approach is that prices for the same goods and services may differ across geographical locations, for example due to different levels of local taxes. Prices are also highly dependent on fluctuations in foreign exchange rates. Therefore, in the case of many goods and services, there is no single market price that could be applied and approved by tax authorities across the jurisdictions where transfer pricing is in fact applied. Cost-based transfer pricing exists in two variants. The first is full cost pricing, where the transfer price takes into account all costs incurred by the production division. As a result, full cost pricing ensures that the authorities in all locations participating in the system receive their appropriate share of taxes and duties. Accordingly, full cost transfer pricing is also accepted by tax authorities across various jurisdictions. On the opposite end of the spectrum is the variable cost approach, which is generally not accepted by the financial authorities of supplier countries. This is because when suppliers only receive compensation equal to the variable cost incurred, then all profits are allocated to the receiving company, that is typically head office. As a result, production subsidiaries avoid paying local income taxes. Aside from market-based and cost-based pricing, there is also a third type of transfer pricing system which is based on negotiated prices. Under this approach, prices used in intra-group transactions are subject to negotiations, which may make it difficult for companies to take advantage of differences in tax and duty rates across various locations. As we have already said, transfer pricing may help minimize the capital group's overall tax burden. This can be achieved by reporting high profits in countries with low income tax rates and avoiding reporting profits in countries with high income taxes. In terms of transfer pricing, this means setting transfer prices in such a way that higher costs are generated in locations with high tax rates, or by invoicing entities located in such jurisdictions with services provided by entities situated in countries with low tax rates. You should be aware, however, that tax authorities in many countries require companies to provide evidence that the prices used in transactions with related entities are obtainable at arm's length, and as a result, a simple increasing or decreasing of transfer prices seldom allows for the effective transfer of profits within a group. Companies attempt to circumvent local regulations by transferring goods and services for which external market prices are unavailable. An alternative solution involves creating distribution centers in low-tax countries and transferring products to them using low prices. As a result, the whole margin on the consumer price is generated in the country with lower tax rates. Certain countries, called tax havens, purposefully lower their taxes in order to attract foreign investors. From the perspective of multinational companies, locating subsidiaries in tax havens is an opportunity to reduce their overall tax liability. A tax haven may be described as a country where many foreign companies and financial institutions function, but there are few or even no production operations. Accordingly, most subsidiaries of multinational companies located in tax havens are intermediaries or entities involved in intra-group lending operations. Aside from low income tax rates, the typical features of a tax haven include low taxes on dividends paid to overseas entities, low political risk, lack of exchange controls, a high level of bank secrecy, and comprehensive tax agreements with other countries. The most known tax havens located in Europe are Luxembourg, Liechtenstein, and the Channel Islands. Examples of American tax havens are the Bahamas and Cayman Islands. Let's now analyze how a multinational company may apply transfer pricing to circumvent burdens resulting from regulations imposed by local governments. We will start with tariffs. An import tariff is a form of duty levied on goods imported from other countries. Tariffs are typically expressed as a percentage of the value of imports. Obviously, the implementation of tariffs will impact a multinational company whose subsidiary is an importer. A potential strategy to minimize that impact is to lower the transfer price for the goods being imported. Please note, however, that a side effect of lowering the transfer price will be a higher level of profitability achieved by the subsidiary, which may stand in opposition to a strategy of minimizing the tax burden. Other types of local regulation which may impact transfer pricing policies are exchange controls. A variety of measures exist that the government of a country may adopt in order to limit the purchasing or selling of foreign currency. Restrictions may relate both to the country's residents and non-residents. From the point of view of multinationals, exchange controls represent a severe problem because they significantly hinder the remittance of dividends. A typical way to avoid exchange controls involves limiting the profitability of subsidiaries which are subject to such restrictions, for example by charging them with royalties or management fees. In some cases, however, local authorities extend exchange controls to cover such payments as well, for example by blocking all remittances to parent companies. Governments of local countries may also implement anti-dumping regulations, under which goods and services cannot be sold at prices lower than their cost of production. The goal of such regulation is to eliminate unfair competition from foreign entities, which potentially may, thanks to using low transfer prices, sell their products at prices lower than those of competitors in order to gain market share. So, anti-dumping laws are in fact means used by local governments to protect the local market. From the perspective of multinational companies, anti-dumping regulations are thus a significant restriction to adopting a fully flexible transfer pricing policy. The above examples of regulation indicate that the perception of certain transfer pricing practices by the governments of host countries may be negative. Indeed, application of transfer pricing is subject to certain ethical issues. Among these, the most important is the social responsibility of multinational companies, whose tax avoidance may be perceived as contributing to poverty in underdeveloped economies. Thus, irresponsible transfer pricing policies may be a source of bad publicity and reputational losses for the company. The process of setting up a transfer pricing policy must therefore include not only an analysis of the impact of the policy on financial performance, but also on the general wealth of all stakeholder groups, including the societies of those foreign countries in which the group conducts its business.